When all else fails to make economies grow, create new money and buy government bonds. That's what the US did with its quantitative easing, and many believe that it got them out of financial ruin. Europe is now trying to do the same to get itself back on track. Joining us to discuss the US strengths and weaknesses and to see what the future holds for Europe is Pierre Vassart from GBS Finance. Welcome.
Thank you, Alex.
Now that the US stock market has hit a new high, can you explain the effects in the post-QE era?
Yes, the market reaction has been extremely surprising because, in fact, after QE stopped, US markets rebounded and hit new highs. And we can see here, if we concentrate on the graph on the US Fed, that in fact the balance sheet has been expanded from less than $1 trillion in 2007 to $4.4 trillion. But this extra liquidity, those additional $3.5 trillion of dollars, they are still there. They are still in the system. They are still in the US, and they are also around the world searching for investment opportunities. And all stock markets around the world are supported by this extra liquidity. What the Fed has done, they have stopped adding liquidity, but they did not withdraw the extra cash which has been put in the system. In order to do that, they would have to sell the bonds which they bought in the previous years, and they have not done that. And in this environment, therefore, when you get reactions in the stock market, the reactions get limited in time, and after a while people buy back, and because the extra cash needs to find a home to be invested. The QE has been having a positive effect on the US economy, which is really pulling along.
So what about Europe, now that Mario Draghi has started a new round of quantitative easing?
The situation in Europe is quite different from the situation in the US. We can see here that Europe has expanded the money supply and the balance sheet of the ECB also up to 2012. But since 2012, the balance sheet of the ECB has decreased instead of going up. The situation in Europe is not the same, and in my opinion, the QE cannot have the same positive effect as there is in the US. So, contrary to the US, where there is an excess of cash, in Europe there is not an excess of cash, and on top of that, in Europe, the tax rates in some countries are higher than the tax rates in the US, which means that whereas in the US, companies have been able to generate cash and have had only a moderate tax exposure or tax liability to Uncle Sam. In Europe, then the tax rate is much higher, which means that the companies have less spare cash and they have been able to generate less profit than in the US. So in Europe, in fact, the QE doesn't have a very favorable effect. It could have even a negative effect, and this is reflected in the exchange rate of the euro versus the dollar, which is now back at the levels of 2012, when Mario started all these big announcements and saying, but everything will be done to save the euro. And believe me, it will be done. And in fact, it has been done, but we are back to square one. And the danger is that even that the euro could fall further below the levels of July 2012. And it's reflected also in the different performance in stock markets, whereas the US is up by 10% approximately. Then the German stock market is down by 2.5%, and the European index is down by 1%.
So what does this mean for investors then? How are they going to be affected in the current environment?
So for investors, then the situation is that stock markets have been obviously they have been supported by this massive liquidity. These are unprecedented levels in the US, in Europe, even in China. At least China has a more moderate growth rate, as you can see in the chart. But this extra liquidity is looking to stocks to invest. And in the US and in many countries, companies are buying back their stocks. So the stock markets now are at levels which are extremely highly valued. And basically, I think prudent investors should look to have highly diversified portfolios. By this, I mean three areas which we have to look at. The first one is one which we've mentioned here a few times in these interviews, is the Asian currency bonds, where at least people, in terms of fixed incomes, they have a fixed income which has strong fundamentals, and Asian countries which have strong debt to equity ratios. And Asian currency bonds have been a top performer this year, as they are up by 14 to 15% year to date, which is extremely rewarding. But on top of that, the big attraction is that they have no correlation with the stock market. So when stock markets go down, at least the bonds go up or keep their value. The second area is absolute return programs, where managers are able to generate a positive return even in a down market, or at least they are able to preserve capital even in a down market. And the third area would be selected commodities which have declined in price, and I'm thinking mainly about the agricultural commodities where prices have been depressed recently due to high crops. But I expect that climatic conditions will change, and eventually they will rebound. The key here is that in a world where stock markets are at elevated levels, buying good companies at a high price, sure, we have the comfort of saying, well, but this is a strong company. But the risk is, and historically it has been proven, that when there is such a massive liquidity addition, like in the 30s, then severe stock market corrections are a high risk if we look on a 2 years to 3 years horizon rather than a 6 months to 12 months horizon. So then the prudent investors should definitely consider diversified portfolios.
Thank you, Pierre. Well, you've heard it here first, investors. Make sure you diversify your portfolio. Make sure you keep checking back into Dukascopy TV to keep updated with the markets. Goodbye.